Right, hello everybody. Welcome to the Trend Signal podcast, the trading podcast that gives you a lively run through of the markets, what to look out for and how to improve your trading. My name is Adrian and I've been trading the market since 2002 and I'm now head of trading at Trend Signal. And today I'm joined with Trend Signal's Chief Market Analyst, Jerry Miller. How are you, Jerry?
I'm fine. Good afternoon all.
Good. So, we've got quite a busy week this week. It's election week in the UK. We've got a few central banks putting a few announcements out as well. So certainly a lot to get our teeth into today. So why don't we kick that off really? And we'll start off with, so what do we know? In this section, we're going to look at really what happened last week, where the movement was, where the opportunities were, and I guess more importantly, how could we have known about it all before the event? So Jerry, what happened last week then?
Oh, yeah, interesting market. Two halves, a week of two halves. We started off last week with some markets were sort of under a bit of pressure. We had some of that angst over that Hong Kong bill that Trump signed, and that sort of caused a bit of sort of ripples in the market. Traders and investors thinking that Trump perhaps then the China-US trade deal would not happen. Trump came out and said he wasn't rushed. He didn't sort of care if it wasn't signed until the election next year, which really sort of, in the second half of the week, rumours circulate in Washington that the first phase of a trade deal is near to signing, and it's all forgotten about. And to be honest, it is a difficult time of year to start shorting markets. And I know we had a real sell-off. We talked about it last week.
Yeah.
But it's not usual. It's not usual, and what plays into the hands of the markets is that it tends to be quite positive. Equities do well, dollar does well, and we had good data out at the end of the week, didn't we? That non-farm payroll.
I mean, that said, we had a bit of a slip sort of November last year, didn't we?
Well, December last year.
December last year. Just feels a bit different now, though, doesn't it?
Yeah.
But having said that, you've got the VIX where it is. We had a bit of a banana skin at the beginning of the week, didn't we? In fact, it's quite an aggressive banana skin, wasn't it?
Yeah, and we did say that you can get stiff-ups at this time of year, but it was short-lived though, crikey.
Yeah, I was expecting more, to be honest. I sort of, I'm going to talk about, what are we trading in a second, but I sort of do feel like there might be another wave lower, but maybe I'm just talking my own book.
Well, it's possible. Surprises and the like, but, the market knows that the Fed aren't going to be doing anything this week. It doesn't seem like there's too much to upset it, but, we're only... Will it be the 9th of December? We've still got a few trading days before the Christmas lull.
Absolutely,
So a lot of stuff can happen. But that non-farm payroll data Friday was so good.
Yeah.
I mean, really, I did wonder when we got that bad bit of data out for October numbers last month. And I thought, how come that's dipped? And of course, there we go. You get a very positive number. Not only do we get a beat on the, we beat forecast for November jobs, but they revised up October's jobs. So I think that the net effect was that there's something like 110,000 more jobs created than expected.
Yeah, that's remarkable, isn't it?
Yeah,
particularly when you look at the unemployment rates out there at the moment. So, it was 3.6, it's now 3.5%. Similar in the UK. These are ridiculously low levels, really, aren't they? Don't they say like full employment's like, I don't know, 7%? I can't remember what the number is.
Well, no, it can be lower than that, but 4%. I remember the FT and a lot of outlets sort of suggesting that full employment, it couldn't get much lower than this. And here we are now, 3.5%. You do need a certain amount of unemployment whilst people change jobs, take time out, all that sort of stuff. But it is extraordinary how tight that labour market is. And it's extraordinary how tight the labour market is without any increase in average hourly earnings. And
yeah, that's the weird thing, isn't it? Because, of course, when there's lower unemployment, people are more secure in their jobs. People start pushing for better pay and all that sort of stuff. And, if you're going to recruit outside of that, you also got to tempt people to leave their jobs to move. You've got to tempt them with bigger pay than what they're already on. So it tends to lead to quite a bit of inflation there, and it's not really happening.
It's certainly sort of a bit of a mystery to some economists, and I think the Federal Reserve would quite like to see a tick up in average hourly earnings. They'd quite like to see a pick up in inflation data, which we get this week, because that's why they're cutting rates. You've got a very tight labour market and no inflation.
Yeah,
that breaks every rule in the book. that I read.
Yeah, absolutely. Okay, so what about sterling then? So bit of flux ahead of the election Thursday. Everyone in the UK, just so you know.
Yeah,
in case you missed it.
It's a big event for us, obviously. Outside the UK, there's a lot of stuff going on with, as you mentioned at the beginning of this, with central bank meetings, etc. But for us here in the UK, yeah, it's a defining moment. We just want some resolution from the Remain-leaning Parliament to Brexit going nowhere. And we had, I don't know, a year or two of this before the referendum in 2016. Here we are, December 2019. If this isn't resolved now, you could just, I think the way it's heading suggests in the polls, in the betting markets, that the Tories are going to get a majority, but a lot of stuff is still up in the air. There's tactical voting, there's all these sort of issues which I don't know the answer to, but all I can say is, Adrian, you and I know the pollsters got the Brexit referendum wrong, they got the 2017 election wrong, they got the US presidential election wrong. They've played 3, lost 3. It's not a great result so far.
It's not, is it? Well, it's interesting. I mean, you look at this website Politico, which I think you introduced me to, Joe. Fascinating. Yeah. You can sort of go back for sort of 5 years or so with the sort of poll of polls here. And what sort of feels different this time is that, this was here, the election in 2017. You can see the Labour line being red, the blue line being the Conservative vote, really tightening up into the election on the polls. I mean, that was quite dramatic, wasn't it? The dementia tax and all that sort of stuff. Very significant change. And actually really tight back in 2015 between the polls, 33, 34, extremely tight. And it really seemed to separate on that election week. So you had this massive change in the week into the election in 2015, exactly the same in 2017.
Albeit a bigger scale.
Albeit different scale, but the point being is a massive change in the polling, whereas it's not really happening this time. They're sort of consistently, like a couple of tram lines really, aren't they? They're both sort of rising as people are sort of increasingly polarised with their vote. It's either Conservative or Labour.
Well, that's the interesting thing in this election, which hasn't helped Labour at all, and it has probably helped the Tories, is how badly the Liberal Democrats have performed. But in a way, they were talking about revoking Article 50, just being the party for Remain. And I think even a lot of Liberal Democrat supporters actually believe that the Democratic view is that we should be leaving the European Union. You can't say we should ignore it and just revoke Article 50. So I think it has become a two-horse race, but that's down to the strategy of the Liberal Democrats, and it's played into the hands of the two main parties, I think.
Yeah. It'll be fascinating, the polls over the next couple of days. But as I say, that if anything, the difference remains exactly the same and has been for the last couple of weeks. So
that's right. Yeah.
Which is well, just different over the last.
I mean, there was a little bit of a narrowing at the end of last week, and the number of seats on the betting exchanges came into about 39 at 44. But it's, as you and I know, Adrian, we're just looking at it, it's about 345 bid now. So. It's just different to the last two elections. It just looks more predictable, if you could say that.
Yeah.
If you dare say that.
Yeah. So sterling had a big rally last week. The very much pushed us into the upside over the last few months, really. In fact, we've seen the monthly trends change direction. We'll talk about that a little bit later. Do you think the rise in the pound is a function of people, the consensus wanting a Conservative majority, or is it just wanting certainty? Is that the catalyst for the rise?
I think the perceived wisdom in the city, where traders and investors are concerned, and overseas investors, remember they're very sensitive to this. A lot of short hedges were put on, so a lot of institutions, traders and investors have put on short positions in sterling following the referendum result, because they were told that Britain would go to hell in a handbasket.
Yeah.
There would be a recession in 6 months. Didn't happen. And then with Boris Johnson being elected leader of the Conservative Party and Prime Minister, he took the stance that he had to renegotiate the Brexit withdrawal deal, and that if you couldn't get one that suited the UK, there would be no deal. And the no deal precipitated further hedging, further selling. That's why you saw sterling hit the lows, what it was at the beginning of September, just below 120, 119, something 119.60, I think it was. And here we are.
So I've got the weekly chart up here. Significant rally from sort of below 120.
Yeah.
Here we are just shy of 132s.
Yeah. So that's 12 cents. So that's significant.
Like 10% rally. That's massive.
But Adrian, it's actually important to understand who is buying it.
Yeah.
There is speculative buying in there, and a currency represents the standing of the country, whether it's going to be positive or negative for it, and you then looking at what's taking place here, that it's going to be a positive outcome to the election, and that is reflected in the price of sterling and what we're seeing in the betting exchanges regarding the number of seats. Who's buying it? I'm pretty certain a lot of it is short covering. So it's institutions, investors, traders, hedge funds lifting those short hedges. So where they've sold,
so they were selling it, they were speculating on the pound falling, and now they're closing that trade off.
Well, they weren't speculating on it falling. They needed to protect themselves against it falling. So it sort of amounts to the same thing. Yeah. Well, whatever it is, they are lifting those hedges. So to close out a short trade, they've got to buy it. So the buying that you're seeing is just that. Sure, there's a speculative element to it, but I'd say it's probably 25-30% of it at this stage. And you will, ironically, when the event is known on Friday morning or Thursday evening after the exit poll, it'll react.
Usually pretty accurate.
Oh, yeah. And so if you don't want to wait up all night, just listen to the exit poll, you have a pretty good idea. Sterling will react to that immediately. That's when it all happened. And that's what happened in 2017 when the exit poll said that there was going to be no overall majority, which was like, you could have had a pin drop at the party I was at.
Yeah. Okay. So, so what else? Anything else to go through from last week?
Yeah, there's some sort of pretty poor data from Germany. Well, it's mixed data from Germany, but there's all this discussion about Germany because Germany is a powerhouse in Europe, in the Eurozone. We do watch all that data coming out with interest because without a strong Germany, the EU is going to struggle.
Yeah.
And this is one of the reasons why I just wonder how high the euro can go, especially when it's now been labelled as the funding currency for carry trades. That's horribly complicated. Just to explain it very, very simply, it's very cheap to borrow euros, but you don't get a great return holding euros. So you borrow euros, sell them, so you're borrowing them at nothing because it doesn't cost anything to borrow euros. You sell the euros and you buy dollars, or you buy sterling, and you get a lot better return for your money. That's called a carry trade. And whilst the euro has become the world's funding currency, it ain't going to go up. No. It should be higher, but it's not at the moment.
Okay, so onto the euro, and we've actually got their interest rate decision this week. So why don't we have a look at what don't we know yet? So we're going to get into effectively the items that are coming out that might impact the markets for the week ahead. So Jerry, we're going to bring the economic calendar up. Let me give us a quick run through.
I'll do a very, very quick run through. Yeah. I know that's stuff you want to get on to. Let's jump to...
Shall I just put the reds up?
Yeah, do. Just do that. My impact ones makes it easier. Okie dokie. No, that's wrong week.
That's last week. What are we doing?
I was just thinking. I've got something wrong.
There we go.
Okay, this German ZEW economic sentiment indicator, it used to be sort of high impact, and then for some reason Forex Factory then demoted it to medium impact. But it's actually one of these really useful forward-looking measures of the state of the German economy. So it's what we call a leading indicator. So it's going to tell us what will happen in the future, or at least it can do. And this is a measure of the of investors and analysts' sort of sentiment. It's something that has struggled. If we can start to see some green shoots in Germany, it will be helpful. Because last week we had this data regarding industrial output that it showed a drop of 5.3% in October from the same month last year, so October 2018, and that's pretty dire. And then you read the stats about the German car industry that employs something like 800,000 people. They're having to get rid of between 50 and 100,000 jobs. Production sales of new cars has fallen something like 15%, and it's all the cream's been taken off the top because of the China-US trade war. There's one thing that Chinese won't be doing when things are looking a bit dodgy is to start buying Bentleys and Mercs and BMWs. Yeah, I'm afraid, and BWs, don't forget them. Yeah, so that's the reason why I'd quite like to see that number. And if we do get a particularly weak number, it won't help the euro one bit. Wednesday, busy day Wednesday. Obviously, we got the interest rate news at 7 o'clock in the evening. Interest rates are always very important for economies. That's how the central bank controls.
We'll talk about that in a second. Okay. That's going to be our definition of the week, so okay, we'll come back to that.
So inflation, core CPI, that stands for Consumer Price Index, so that's inflation to you and me. And we look at the core number in the US, they strip out the volatile food components. And all I would say is just one word, and that's benign. There ain't much going on there.
And we're not really expecting much going on to do with the Fed funds rate, are we? Interest rates in the States, the bank rate.
Nothing there. And then we've got the European decision, the ECB rate on Thursday morning, and also something I glossed over when we discussed it. Oh, I'm not sure. Is it monetary policy assessment? I'm not sure. It's the Swiss National Bank's.
Oh, yeah, that's. Yeah. It says it all when they stick it in as an amber announcement, really. The S&P policy rate.
Well, that's because they never ever do it. They've kept their rate at minus 0.75% for, well, since I think you're in short, so I'm not sure.
Not attractive.
Anyway, so obviously the elections we've talked about. The European Central Bank is the one of interest. It's of interest because, unfortunately, like the Swiss National Bank, there's going to be absolutely no change in policy there.
Yeah.
And the reason why is that it's Christine Lagarde's first rate-setting meeting, and they said in the previous meeting they're not going to be doing anything. A bit like the FOMC, who are going to do nothing in the US as well, because they said last month, that's it. They're not cutting again because they've cut them 3 times in the last 3 meetings.
They want to see the effects now.
Yeah, they want to see what effect it's having, and those effects can take 6 to 9 months to feed through.
Would US retail sales be quite important? We've got obviously in the aftermath of Cyber Monday, Black Friday, and all that all those shenanigans.
Yeah, they are. They used to be a lot more useful, and perhaps in this particular week, with them following on from the rate decision, retail sales are pretty much sort of as expected from last month, so not much change. So nothing too much there. But if we have a particularly strong showing, that might start to put some of the interest rate expectations next year back a notch or two, because having had a strong NFP, non-farm payroll number last Friday, retail sales is another interesting number that people follow quite closely. So yeah, I agree.
That's inflationary, isn't it? So okay, good, lovely. And of course, a little thing called the general election. So that sort of brings me on to the next bit, really, of the session, which is to do with what should we be trading. I'm just going to have a look at a handful of markets just to see what's really going on with those. It shouldn't take more than a few minutes, everybody. I'm going to start off with a quick look at the pound. We talked about that a little bit already. Who's at Goldman Sachs had a target at sort of 132, you were saying. If a majority comes through, that was a little while ago.
It's a few months ago, but it's interesting how perceptions have changed. When sterling's back, down on its lows, I suppose 132 is a long way away. But
curiously, our Trendsignal weekly pivot point predicted that back in March or May this year. So 131.99, but that really is the short-term target. And as I said, we're pretty much there. And this goes back to the risk being very much to the short side, that we're pretty much there, if you like, of where it was likely to get to. I think we still think, if it's a convincing majority, it'll shoot to the upside. But if there isn't, I think there's probably probably a bigger fall, more like to take place than the size of the rise, if that makes sense.
Yeah, I mean, the fact that sterling is rallying 12 cents against the dollar is
it's pricing in already, isn't it? Important. So effectively, if we're pricing in a majority and the majority comes in, well, you've already got the majority and it's already priced in, so you wouldn't really expect it to move too much, other than perhaps a little relief rate, maybe.
There may be some sort of speculative interest in that pushes it up. I think it could it's possible it could spike up to the 140 area.
Yeah,
possibly. But if you're at 132, that's only 8 cents, and because it will only 8 cents, but that's a big move, isn't it?
And 140 is not beyond the realms. I mean, it was there back in sort of April last year, so it's not that long ago.
Yeah, you look at what sterling did, in, what is it, end of October, it rallied sort of, I don't know, 8 cents. So you can have big moves quite quickly, and sterling's notorious for that. And the risk to the downside, well, you may think it's unlikely. The pollsters may say it's unlikely. The betting exchanges may say it's unlikely. But we've already discussed they don't have a great track record. On the downside, if there is no workable majority, or if there's a hung parliament, and God forbid, certainly for the city and sterling assets, if there was Labour S&P alliance of sorts, it would be disaster. It would be disaster for sterling assets. I think sterling would trade below 120, maybe 115. So when we talk about risk, it doesn't mean we necessarily think that's going to happen, but there's a greater potential on the downside at this stage, albeit the probability of that downside is lower than the move on the upside.
Yeah. I mean, it's interesting. We look at this this chart here. This is the monthly now. So we've turned up on the monthly on pound dollar, having hit this sort of support pivot back from 2017. So there's a lot to be excited about on the upside for pound dollar. It's just a question of what the result on Thursday is. I think that's really what it comes down to. So in terms of what should we be trading, maybe just be a little careful in the run-up to the election from Thursday. Let's get that out of the way. I think then it'll be a lot more interesting to trade the pound. And I think probably what could be quite a lively few months really after that.
And the important thing is it removes that uncertainty, probably certainly about the election and probably about Brexit.
Yeah.
In which case, I think it becomes a lot, let's say, more predictable. When you start to get some decent swings, you can start to rely on them and trust them more. Yeah, and that you're not going to get some sort of comment, an impulsive move from the European Commission or the British government or Labour or something.
Yeah, that's right. Interesting then. Okay, so that moves on to the equity market. So we've got the S&Ps here. Short signal on, what was it, Tuesday last week. We didn't take it because one of our rules is if it's against the trend and it follows what we call a continuation trade, because it's so heavily against the trend, we just don't take those that opportunity. In fact, what we're really doing is waiting for the next buying opportunity really here. It's an interesting time for this market though, because I look at this level, this pivot point here, 131.47, which we nudged on Friday and sort of rejected that level marginally. We're holding off it. It's just where my cursor is in the horizontal line across there. It'd be interesting to see if we get a failure from here. If it can't break through there, often a pattern that people often like to see is the market's had a big run up. It tries to have another go at it. And if that fails, and that's really going to expose the market having a lack of buyers up here. So if it does fail, starts to ease back, you could end up seeing it falling quite hard. But we just have to keep an eye on that. I think really, see that number there, that 31.47 for the S&P cash. I think if we can see a close above there, a convincing close above that number, it should lead to higher prices. If we continue to reject that, I think we'll really see more of a downtrend carrying on with the S&Ps. But we'll see, as Jerry mentioned earlier, sort of seasonally relatively strong for equities. However, when you look at the VIX volatilities at the moment, there could still be room for the downside. But I do think that 31.47 is a pretty key level for the S&Ps.
I mean, you get people arguing, providing a case for markets coming off, and of course there's so many different reasons why it could.
Yeah.
But equally say, we're up at the highs. They're not at the highs because people are selling. They're up there because people are buying.
People like it, absolutely. Yeah.
And you could say, well, market breadth, look at the fact that it's been driven, certainly, and that's been driven higher by a few number of stocks. You have to look at the likes of Apple. Look at it.
Yeah. Quick question here, Shakti. What does the IG call the S&P 500? I'm not too sure. Probably the US 500, something like that, or the S&P. So the S and so the and symbol P 500 be something like that. Probably
US 500.
Yeah. If you look at US indices, though, you'll see it, and it'll be really the only one that's for 500 instruments, Shakti. So you've got the Dow, which is 30 stocks. You've got the S&P 500. You've got the Russell. So you don't generally get the Russell on UK brokers. It's not really traded so much. So that's broader markets. The US 30s, Wall Street. Okay, it's probably the S&P 500, something like that.
US 30.
Or US 500, be something like that, Shakti. Okay, so what else? I brought the FTSE up here. FTSE is going to be a little bit of a slave to really what happens with the S&Ps, to tell you the truth. I mean, the market will generally follow that market. It's less affected by the whole Brexit thing. Why is that, Jerry?
Well, because it's largely dominated by international companies that don't really have a business. In fact, a lot of them mining companies, a lot of financial companies are not just here in the UK. They're large, they have a lot of overseas earnings. And in fact, the FTSE tends to be more affected by the currency. And you saw that after the Brexit vote.
Oh, gotcha.
Sterling slumped. And the FTSE slumped. I remember thinking, I wonder if sterling is slumping, surely that's making it cheaper. Lo and behold, the thing absolutely took off. So it's a question what happens with sterling, really, and that's one of the reasons why the FTSE has not done what the DAX, what the S&P, Dow, Nasdaq have all done. And it's a waiting game. But if you had got a chart on the FTSE 250, that's UK PLC, and that would look completely different.
So just to be clear, in layman's, it's going to follow the pound a little bit more closely because of all the exports that these companies are
so it's
overseas trade, basically.
Earnings translated into pounds, but also if you're in the United States and you've got dollars and you're looking at the cost of buying a share in the UK in sterling, if sterling's strengthening all the time, the cost to you in dollars is going up and up and up. Whereas if sterling's falling, you could look at some of the stocks in the FTSE and think, hey, God, these look at good value. So that's an important factor to take into account, apart from the fact that no one's going to make any decision before an election, that's for sure. So the whole thing is going to be on hold until Friday morning.
Yeah, I think that's kind of the thing really with this week. You've got the interest rate stuff, although that's not really going to be a big impact, but certainly the election. So probably a case of just holding fire on the pound, holding fire on the FTSE, and let's just see if we can get a few fireworks on the S&Ps that can really create some movement really on those markets. So we got a couple other bits to go through, to go through defining trading, with interest rates being a key focus of the week. Trying to just take a little look at to do with base rates. This section only looking at sort of a minute or two, guys, so don't worry, it's not going to be too stale. But, Jerry, just let us know for a second, how do interest rates, so you've got FOMC, you've got the Federal Open Market Committee, you've got the Monetary Policy Committee in the UK, you've got ECB in Europe. They can change their base rate, and that's effectively interest rates, because what does that all mean? How does it all work? Let us know.
Most central banks, in fact all central banks, they are charged with managing inflation, so price stability.
Yeah. Okay.
And monetary policy is determined by interest rates, because that's how you control inflation. So if you charge more money to borrow money, it'll dampen down inflation. So it's a great way of slowing down an economy or speeding it up. At the moment,
and that's because banks get their liquidity from the central bank.
Well, the transmission of what the central banks do is via the banks, correct? Yeah. You don't, as an individual, you wouldn't borrow money from the central bank. It goes via the usual channels, whatever those channels are. But the key thing is central banks control the velocity and supply of money. And that's the way they slow down or speed up inflation. That's the general rule. It does take a while for those effects to come into place, and it's a bit like steering an oil tanker. If you want to take a view on inflation now, i.e. if it's slowing, you've got to open up the sluice gates a little bit and cut interest rates to encourage it now, and it'll have an effect over the next 6 to 9 months time.
Okay, so when you cut rates, the idea being that the banks will pass some of that saving on to individuals, which effectively means that our mortgages are cheaper, so we've got a bit more disposable.
Cost of borrowing goes down.
So effectively, and it makes our savings less attractive, so we may as well spend it instead of leaving it there and probably losing money against inflation. So effectively, cutting rates makes us go out and spend more, gives us more disposable income. Raising rates effectively will slow the economy down. But what's the impact then on the actual pound? So if you were to raise rates, what would that typically do to the pound then?
Well, what that does, it makes sterling look more attractive to investors.
Because of rates of return.
Because they're getting a better interest return on their money. And that's, it's important, and you'll often see a big flow of capital, and it can flow very easily these days. If you get a sudden surprise, like the Bank of Canada cutting interest rates, or the Reserve Bank of Australia cutting interest rates when they weren't expected, literally within an hour, the currency will slide maybe 2.5%. And that happens because people can move money out of a currency very, very quickly these days.
So effectively, if they were thinking they're going to be getting, say, 0.5%, 0.75%, all of a sudden it's changed. Actually, it might attract a lot of money. Suddenly, a lot of money might go out of the economy, out of that, currency.
And there has been pressure on the dollar, but it's been well, how can I say, telegraphed to the extent that we all know that the Federal Reserve have been cutting rates. And it means if you hold dollars, you're getting a lower return on your dollars. Yeah. And you might think, well, hang on a second, Jay, I thought you said that would weaken the currency. What is it weakening it against? The fact is, all the currencies that we're talking about, sterling, Swiss franc, Japanese yen, euro, their rates are just down at nothing.
Yeah.
In fact, the euro is down at more than nothing, at minus 0.5%, which is less than nothing. Same with Japanese, same with Swiss. So the US is out on its own, really.
Yes, absolutely. Yeah. Okay, well, hopefully that's useful. So the general rule of thumb, if interest rates are more likely to rise, given any economic data, that's likely to be positive for that currency. And if they're less likely to rise or more likely to go down, then it's likely to be weak for the currency.
Having said all that, of course, there is a general understanding that you're not allowed to manipulate your currency by cutting or raising rates. That is one of the consequences of it. But remember, Mr. Trump has already slapped tariffs on the likes of Brazil and Argentina for deliberately creating their currency because it gives them a competitive advantage.
Yeah.
Anyway, there we go. Big subject. Not much time to talk about it.
It's a big subject actually, because it sort of moves into sort of the problem. What's the problem that we want to sort of have a look at? We've got an election this week. And we've got, a couple of central banks this week. And these are big data items. So the problem I want to sort of go into just a couple of minutes into before we head off for the day is really to have a look at what's called slippage, or the speed of price movement after major events. So when you have something like a general election, you have interest rates. Those are things that have the biggest impact on prices. And generally speaking, you go back to the economic calendar that we were looking at a few minutes ago. What's expected, really, all other things being equal, shouldn't really change the price. If that's what the data comes out at, it shouldn't really change the value of the dollar or anything, because that's what's priced in. The impact on prices comes where the data is different to what's expected, higher or low, whatever. And the more extreme, the more likely you're going to get a bigger movement. The more relevant, the more important the data, again, the more extreme the movement in price could be if there's a shock announcement. So interest rates are as big as they're going to get. Non-farm payroll in the US, which we had last Friday, non-farm employment change, whatever you might want to call it, that's also very big as well because of the mandate for the FOMC makes their unemployment data very, very important, but also general elections as well. So the reason why I'm talking about this is that big movement in price, whilst it can be exciting, can also be quite dangerous, and that's something to do with slippage. And slippage is when the price that you want to trade at is different to the price that you end up getting filled at by your broker. There is a difference in that price, and that's because when markets move very fast, effectively you are matched the first available buyer or the first available seller at the market price. So you're going to be matched with that buyer or seller. So if the market's moving very, very fast indeed, your order's triggered and you'll be matched with the next one. So if the market's moving too fast, it won't be at the price you wanted anymore. It'll be the first available buyer or seller. So what that basically means is, over big market data, the risk of slippage is increased. And if you have a look at something like a market depth picture here, you can search on Google Images for level 2 or market depth, whatever it may be. And the reason why you get slippage or fast movement is usually over data that the orders that are in the market are often reduced, they're pulled, and that leads to big, fast movement in price. So if you look at this chart here, on the left-hand side, this is the S&P 500. You've got all the orders that are working to buy at these various lower prices, and the red ones are all the orders to sell working at all these higher prices. It's called the depth of market. So for example, at 1653.5, there's 1,188 contracts looking to sell at that price. What you'll generally find over important data is the number of orders that are working will reduce. So people will cancel, institutions will remove, cancel, delete their orders, which makes the market much more thin. Okay, so when you get a big shock item of data, the market will move a lot faster because less contracts are needed to be traded to push that price. So hopefully that's all making sense. Basically what it means is the higher the impact of data, the more it is away from expectations, the faster the market is going to move, and the more likely it is you might get slippage, and arguably the more dangerous it could be for your account. That's why trading over major economic data is a dangerous thing. Now, a lot of people have you believe it's a great thing because it's opportunity and it's movement is fantastic. And in the aftermath, yes, you get a lot of movement from it. But right at the moment, right on that heat of the battle, it's actually quite a potentially risky thing to do. So for that very reason, unless I had a massive position or something like really important to do over the election, I would not be in the pound on Thursday night or Thursday, just simply because the risks of whatever it might be is too great.
Or the FTSE.
And a lot of people might think it's 50-50. It's not because of slippage. It's not. The odds would not be in your favor because you're not going to get exited on your trade or maybe even enter your trade straight away at the price you wanted. It's likely to be worse than you wanted.
Well, even 50-50 is no good because you might as well just toss a coin.
Absolutely, yeah. Well, no, the point about 50-50 is, well, you know, it's okay, I can deal with that. It's not. It's going to be like 70-30, 60-40, whatever, depending on how fast that market is moving.
Remember, the institutions that make a market and put their prices in here, they're there to make money.
Absolutely.
They're not there to be mugged off.
Yeah, that's right. And they're going to pull a lot of those orders coming into major data, which is why you see those bigger candlesticks over economic data, the big spikes and so on. It's not necessarily because there's lots of trading, when there might well be, but it's because the depth of market is a lot thinner, which creates more speed of movement. Okay, so hopefully that's useful there. So guys, that's pretty much it from us this week. So a couple of bits I just wanted to just get off my chest, if you like, before we do finish off for the week. Our podcast is now available on a few different channels. You can listen to it on Apple iTunes, you can listen to it on SoundCloud, Spotify, you can watch and listen to it on YouTube, or even just on our blog page. You've got the web page on screen now, so trend-signal.com/trend-signal-blog. Doesn't exactly roll off the tongue, does it? Or you can search for the Trend Signal podcast on those various platforms, iTunes, SoundCloud, Spotify, and YouTube there, guys, and you can tune into that every Monday. We release that. Now, guys, if you'd like to know more about trading opportunities, because the action doesn't just stop with this podcast, I'm hosting some live events this week where you'll actually get to learn 3 core rules for one of my favorite trading strategies, one that I continue to use every day. So if you'd like to learn them, I'd like to learn those 3 rules for identifying trades, please register for my next live and online event by heading to bit.ly/learnts. So it's a bit of a weird link, isn't it? bit.ly/learnts. They'll take you to our registration page and you can book for one of those live events. So complete that session. It's online, it's interactive, and it's live. And that's it, guys. Have a great week. And yeah, catch you on Monday.
Yeah.
Next week.
Bye for now.
Bye-bye.